very good afternoon, everyone. Thank you for joining us for the ISAS panel discussion on India's digital currencies, the road ahead. India's latest budget announced the country's plans to have a sovereign digital rupee in fiscal year 2022 and also proposed a 30% tax on earnings from virtual digital assets. The announcements reflect the beginning of India's efforts to embrace digital currencies as the next step in the evolution of digital financial transformations in the country. Today's panel discussion will examine the prospects for India's digital currencies and identify issues that might arise in the evolution of regulations. Before we proceed with the event proper, I would appreciate if you could switch off your videos and mute your microphones throughout the session. If you have any questions, please forward them via the Zoom chat. We will consolidate the questions for the panelists to answer during the question and answer session. This afternoon, we are delighted to have with us the following distinguished panel of speakers. Mr. Vinod Rai, Distinguished Visiting Research Fellow at ISAS and former Comptroller and Auditor General Government of India. Mr. Saurav Bhatia, Global Head of Digital Assets, Retail and Private Bank, Standard Chartered Bank, Singapore. Ms. Neha Mehta, FinTech Team Lead, Economic Reform Program of Southeast Asia, Foreign Commonwealth and Development Office, Government of the UK, and founder Femtech Partners, and Ms. Meghna Bal, Fellow Asia Center and Consultant Quant Advisory, India. Chairing the session is Dr. Amitendu Palit, Senior Research Fellow and Research Lead, Trade and Economic Policy at ISAS. I shall now pass the floor to Dr. Palit to begin the proceedings. Over to you, sir.
Thank you so much, Divya, and let me take this opportunity to welcome all our listeners to the program on India's digital currencies, the road ahead, that we are so happy to bring to you today. I think it's not going to be an exaggeration if I say that in a number of ways, and most specifically with respect to digital currencies, the budget that the Finance Minister of India presented on the 1st of February this month has been a historic budget. This is a budget which probably has opened the first phase of India's progress onto digital currencies and the way it will integrate with the rest of the world through exchanges and transactions in digital currencies. In many respects, this is consistent with the effort of India to proceed to digital transformation and digital delivery of services in various parts of the lives of its citizens, a trend which has been consolidated and accelerated to an extent after the outbreak of the COVID-19 pandemic. But even then, there was probably not a very high expectation of India and the government taking a very precipitate position on digital currencies as it did in the budget. Many of us would recall that prior to the announcement that came in the budget, there was a lot of conversation in India around the future of private digital currencies, which are broadly referred to as cryptocurrencies. There was a report that was being looked at by a committee of the parliament. There have been very sharp views on the future and prospects of cryptocurrencies between the Central Bank of India and the users of cryptocurrencies. And according to some statistics, today India has the largest number of crypto holders in the world. It is definitely a matter of recognition when one looks at the discussion around cryptocurrencies in India to note that practically most major television channels are organizing programs discussing the trends and behaviors of several cryptocurrencies. Newspapers are reflecting on the evolution and the way forward on cryptocurrencies. So which essentially means that the interest on cryptocurrencies in India is very, very large. While the budget has not really, and I'm conscious when I use this word, the budget has never mentioned the word cryptocurrency in the speech of the finance minister. What it has also done is that in addition to announcing that India will soon be launching a sovereign digital currency, which will be called the e-rupee or the digital rupee. It has also announced a provision for taxing virtual digital assets. Now, this has, of course, given rise to a large number of questions, including the most fundamental one being that while there was a call proposed by several stakeholders that cryptocurrencies or private digital currencies in India should not be considered legal, does this announcement by the Ministry of Finance in the budget make them legal? This is a question which, of course, we will try to reflect on in as great a depth as possible as we have the time and the scope today. But this is a question which is going to live with us for some time as all of us look forward to the developments around cryptocurrencies in India. But before that, I have my great pleasure in inviting the four very distinguished panelists who are going to join me in the conversation on digital currencies today. They have already been introduced by Divya to all of you. Mr. Vinod Rai, Mr. Saurabh Bhatia, Ms. Neha Mehta, Ms. Meghna Ball. I think it's a wonderful time, wonderful opportunity, and a great group of panelists. I'm honored to have the opportunity to moderate the conversation between them. And we look forward to not necessarily answering a large number of questions today, but perhaps, if I could describe it that way, raising a number of questions, which I think will going to live with us in the crypto community, the expert community, the academic community on this subject, and more specifically with us as an Institute of South Asian Studies focused on policy and regulatory developments taking place in India and South Asia. These are questions that we would like to retain with us for our medium and long-term conversations. So without further ado, I would like to welcome Mr. Vinod Rai as the first speaker on the panel. Sir, the floor is all yours.
Thank you, Amitendu. Thank you very much for inviting me to this discussion today. I'm in total agreement with you that those of us who have been budget watchers and people of my vintage who've been watching it for a long time, the single big bang announcement in the budget for 22-23 was that India's central bank, the Reserve Bank of India, will issue a digital rupee or a central bank digital currency probably in early 2023. This digital rupee, it was announced, may be based on blockchain and other technologies. Now, in doing so, India would be one of the largest economies to introduce a so-called central bank digital currency if it sticks to its plans in the current year. And I say the largest since it appears that only the Bahamas and Nigeria have been the first off the block, and most countries are researching the utility and potential of CBDCs, with another large number experimenting with the technology and only a handful having launched pilot projects. Now, the government announcement maintained that the introduction of a central bank-backed digital currency will give a big boost to the digital economy of the country, and the digital currency will also lead to a more efficient and cheaper currency management system. Now, while India is pushing forward with the digital rupee, it has, on the other hand, tried to take a tough stance on cryptocurrencies like Bitcoin and is currently working on regulations for the sector. Now, some of you may recall that an interministerial committee had recommended the introduction of a CBDC sometime in November 2017. However, nothing much came out of that recommendation for about 4 years. But the debate around digital currency gained traction after the RBI was faced with exponential increase in transactions in cryptocurrencies as an alternative to currencies ordained by the government's fiat. Now, Bitcoin, the most prominent of these, has caught the imagination of potential investors, with the tribe of such committed investors mushrooming much to the chagrin of the RBI. Now, an October 2021 study by broker comparison platform Broker Chooser claims that there are 100 million crypto users in the country. In fact, in 2018, the RBI imposed a ban on cryptocurrencies. This ban was contested in courts and finally revoked by the Supreme Court in 2020. The government, on the other hand, made an aborted attempt to introduce a bill proposing a blanket ban on all forms of cryptocurrency. I say aborted because it met with huge public resistance and since has not seen the light of day. Now, while announcing the issuance of a CBDC, the government has also introduced, like Amitendu mentioned, a 30% tax on returns from the transfer of virtual digital assets. This is with a host of other regulations to plug taxation loopholes and remove ambiguity. It could have been devised to discourage investment in cryptocurrencies. Now, this tax will also not be allowed to be set off against other expenses, increasing the tax burden on cryptocurrency investors. Gifts also of crypto assets will also be taxed, with the recipient paying 30%. Now, virtual digital assets have been defined in the finance bill to cover a wide range of emerging digital assets. So the government has cast its tax net really wide. In the earlier regime, crypto gains were either treated as regular income and taxed at the marginal rate or as capital gains or business income. One viewpoint is that since the new rates will be applicable from 1st April 2022, crypto asset owners have the option of selling their assets and be taxed at the present lower regime. Now, it is widely believed that the tax clarity on digital currency transaction is a very positive step forward since this will bring in standardization. Some, however, feel that the flat 30% could push a lot of retail customers who looked at crypto as a portfolio investment to move out. Secondly, each tech adopter could shift base. There might even be a brain drain with startups also moving out of the country. However, it needs to be acknowledged that the government is taking a progressive stance by going ahead in the direction of innovation. By bringing in taxation, the government seems to legitimize the crypto industry and trading to a large extent, and Amitendu, you alluded to it. This makes it now possible for institutions that have been sitting on the sidelines because of uncertainty on this aspect to participate in this emerging market with their investments. In fact, even the taxable rate of 30% is considered relatively high. Any form of government regulation of cryptocurrency is encouraging, as it goes a long way towards validating the asset and making it more mainstream and widely accepted in everyday business and commerce. Meanwhile, global crypto experts believe the government's announcement of 1% tax deduction at source at the time of transfer of digital assets may turn out to be a powerful tool to track government or these transactions. Now, the issues that are being debated are the effect that CBDC may have. And on this, a variety of opinions have emerged. A variety of opinions have emerged on the effects that a digital currency could cause. Firstly, let's take up banks. A CBDC could cause a shift away from bank deposits. Reduced disintermediation of banks carries its own risks. If banks can begin to lose deposits over time, interest margin might come under stress, leading to an increase in the cost of credit. In fact, banking stakeholders have already begun raising concerns over the potential drop in deposits, disruption in debt markets, reduction in credit creation, and impact on lending rates due to retail CBDC. I feel that it may even lead to a denial or tighter credit availability to the lower segments of society, and I'm talking about farmers, laborers, irregular income earners, and the like. There are the very people for whom so much effort has been undertaken and addressed to open Jan Dhan bank accounts and the like, basically financial inclusion efforts. A digital rupee will be sent and received by private citizens through digital apps, loaded on their phones and guaranteed by the RBI. This would reduce the need to keep money in bank accounts or transact through them. And if banks have less money in their accounts, they may have less to lend. That means loans would get that much more expensive as the interest charged will be higher. And that's where it affects the lower strata of society. So it is critical to understand that CBDCs may reduce transaction demand for bank deposits depending on the degree to which they are used. Because transactions in CBDCs lower settlement risk, they may also minimize transaction liquidity requirements such as intraday liquidity. We may thus be treading in totally uncharted territory. There are also the second issue of security concerns. There will also be issues of privacy and security to be figured out. Unlike a paper currency, totally anonymous, totally unknown, totally nondescript, a digital currency will leave a digital trail across the transactions. So unless a CBDC is designed as a robust data governance and data protection framework, it will be well nigh impossible to balance between safeguarding privacy and oversight for the prevention of financial crimes. Then the issue about cyber attacks. The risk of cyber attacks, fraud, and cheating, particularly in a country with low financial literacy levels like India, is also worrisome. CBDC ecosystems may be at similar risk for cyber attacks like current payment systems. Thus, ensuring high standards of cybersecurity become that much more critical. Now, concluding, I'd like to say that the real impact of the digital rupee still remains hard to predict. Much will depend on what shape and form it will finally debut. RBI is looking at various models that could offset the adverse impact on banks and is very cognizant of the hitherto unbanked section of society who are to be brought into the banking fold. But where India has an immense advantage is the way it adopted fintech in recent years, especially its spawning of UPI that has become, I think, a runaway hit. This does augur well for the digital rupee. Going forward, CBDCs are expected to be a part of any central bank's armory. Setting this up will need careful calibration and sophisticated execution strategy. So we'll have to wait and see what character the CBDC finally takes. It is only then that the fallout can be assessed and acted upon for mitigating steps that would need to be taken. So finally, I think the proof of the pudding is in its eating, as I'd like to say. Thank you very much, Amitendo.
Thank you so much, sir. It was really wonderful. As expected, you covered all the issues connected to the subject from a broad perspective in the most cogent and effective manner possible. And I think what that has made possible now is that on the basis of what you have shared with us, you have reflected on some of the tricky aspects of going ahead on the regulations on this. On the basis of that, let me invite Saurav Bhatia, the global head of digital assets at the Stand Chart, to share with us your perspective, Saurav, and we would be particularly interested in not just hearing from you what you think of these pronouncements by India, but what is also the state of play on digital currencies across some major emerging markets of the world. Over to you, Saurav.
Hi, I'm Amitendo. Thank you for having me here for the session. And thank you, Mr. Roy, for bringing out all the various aspects of this. Interestingly, as part of my role, I'm actually involved in some of the work we're doing for ECNY, which is the China initiative, eNaira, which is the Nigeria initiative, and a few other countries which are in early days of working through this, right? So it gives me an interesting perspective on some of these challenges. But maybe if I start first by saying, I think two topics get commingled and lead to different discussions or views, right? One is cryptocurrencies and speculative nature of their asset, which is Bitcoin, Ethereum, tokens, and other things. And I think the second bucket of it is central bank digital currencies, which use crypto technology, i.e. blockchain or other capabilities, to in a way create, in most cases, a proxy of the same currency that we use today, whether it's a Sing dollar or an Indian rupee or a Chinese renminbi, renminbi, right? So it's important to understand that both of them are serving different purposes. So when we talk about CBDC or a central bank digital currency, it is meant to leverage in a certain construct blockchain capability to, as Mr. Rai highlighted, bring out either efficiency in the process, efficiency in the banks, efficiency for companies, because at the end of the day, a lot of the blockchain technology today leverages what are called smart contracts. Those contracts are kind of autonomous scripts or programs that may not need a person to interact, and that can interact at a very different capability with a central bank digital currency or a cryptocurrency. And that's why there's value versus a Bitcoin or an Ethereum or some of the other tokens, which have turned into speculative assets because they have increased in value, people buy into them and do certain activities. So I think it's important to keep those two discussions almost a little separate as we go into them. So if I looked at countries like Nigeria or China or other places which are looking to bring in cryptocurrency, similar to how India is thinking, a lot needs to be thought through on how that implementation will happen. Is the ledger public? Is the ledger central to the, I guess, the country or the regulator, but has endpoints which connect to people? How will taxation happen on those? Ideally, actually, CBDC in itself is not or should not be taxable. The activities are taxable, but not CBDC because it is in effect the rupee itself, right? Versus, if you looked at Bitcoin, Ethereum, or other assets, those are crypto assets. So I think I almost want to encourage people to think of them as two blocks of activities. Now, CBDC is, like it said, meant to create efficiency in the system and allow people to leverage this new technology which is coming out to build businesses and models which are, either a cheaper, better, faster, more inclusive, and allow, potentially people who otherwise were left out of the financial system because financial institutions had a certain cost to serve, which was expensive because of things around settlement, things around transaction costs, things around various things. And as central bank digital currencies ride on blockchain technology, they could in theory ride on lower cost, lower constructs to enable it. But that doesn't come without an initial, I guess, investment in that infrastructure, both from the country and the organizations involved. And it doesn't come without risks or challenges like Mr. Rai raised around privacy, around transaction costs, around how various I guess entities will engage with that. I mean, one of the advantages of a CBDC or a currency backed by a blockchain is you could actually make the money itself programmable. Like today, one of the challenges which you face is when tax grants are given or grants were given to US citizens to say, you can go spend this money. Many of them may use that to buy stock in the stock market. Versus if you actually wanted to say that this currency could only be used for actually paying for, I'm making it up, food or basic necessities or whatever, you could, in theory, if all the infrastructure existed, program money to say, this is available for 90 days, will have these specific purposes, and this is how it will work. So CBDCs have the power of leveraging new technology, which will continue to grow over time, which is the blockchain technology, and more programs and capabilities will be able to with lesser human intervention, be able to work with them. A smart contract can hold a crypto or CBDC as collateral and transact. While in a traditional, what is called digital money today, you still need central intermediaries. So when you look at what we describe as digital money, it is actually still backed by an intermediary such as a bank or any other financial institution or provider. And that's what CBDCs aim to kind of change a little. I think going on the topic which you had raised earlier was around taxation. I think when we looked at cryptocurrencies, i.e. the speculative part of the asset base, which is Bitcoin, Ethereum, Solana, other assets, there are still challenges on how you would tax them. And I've been fortunate or unfortunate to have colleagues or friends in the US or other countries which have already started, taxing these items, and it's not a very simple process. So if, for example, you go to a McDonald's and use your crypto card to buy a burger, it is actually considered sale of the crypto, because at the point of sale, McDonald's converted Bitcoin to USD and you sold it, and in effect you have to be taxed on it. But if McDonald's accepted Bitcoin and held it as Bitcoin without selling it, it's considered transfer, and that's not taxable, or in some ways it is, or whatever, right? So I think when you get into the nuances of each of these elements, it just gets more and more and more complex, right? How do you tax it? How do you track it? And one of the basic tenets of crypto is not the centralized nature of what you see on exchanges. That's the speculative part of it. So imagine if you went out and you bought yourself an NFT with Ether, which is Ethereum, should you be taxed for it? Because you sold currency A and bought currency or item B. And I think regulators or people who are building out tax laws may not be as close to the nuances or the practicality of crypto, or may need to think through those with specialists to understand it, to understand which items should be considered taxable, which should not be considered taxable, and how would we go ahead from it. Because otherwise you'll end up creating an extremely complex system, which would be hard to administer and will introduce a very high cost for both the individual and the country overall. So as an example, crypto have this concept called airdrops. If you've used a site, somebody could say, you know what, I'll give you free tokens. Some tokens start with a value of 0, and then they go up in price. Some start from a certain price. And I'm sure, I'm not a tax expert, but the tax implication on both things is different. So I think it's a space that needs a lot of specialists who can explain to you what's happening, to partner closely with regulators and policymakers to really lay out what the implication on many of these things are. That's really it from me.
That's great, Saurav. In fact, I really want to congratulate you for highlighting two specific aspects of the subject that we are dealing with. In fact, you went into a little bit of detail following what Mr. Rai had alluded to. The first, I think, is the mother of all questions, that, if you are referring to something, a product, as currency, then what does that actually mean? I mean, the currency is a medium of exchange, as we know all currencies to be. Currencies can be a store of value. But what we are getting to see today is a diversion of thinking between two functions that currencies can probably be used for. The first is a medium of exchange, and the second is their value, which they pick up from their role as assets. And when we look at the Indian budget, for example, there appears to be an understanding that when it comes to virtual digital assets, these virtual digital assets are being held by most of their owners as assets, and as you refer to as assets which have lent themselves to speculative gains. So those can be taxed, and that is where the proposal of the taxation has come in. Whereas on the other hand, a sovereign digital currency will be purely used as a medium of exchange, backed by the sovereign. So there is no asset identification to that. But whether it is that simple as we look at the subject going ahead, and in terms of a regulatory consistency, something that we really need to think through. And I'll come back to you with more reflections on this as we go ahead. But in the meantime, my great pleasure to invite our next panelist, Neha Mehta. Neha is the FinTech team lead for the Economic Reforms Program of Southeast Asia for the Foreign and Commonwealth Office of the Government of UK, and she's also the founder of FinTech Partners. Neha, the floor is yours.
Thank you, Amitendru. It's a pleasure to be here today. And as we do this sitting in Asia, my heart goes out to what's happening in Ukraine. And it's good that we're talking about digital currencies. And we have seen how Bitcoin is coming to rescue a lot of Ukrainians right now. So that's a great effort. I think the flip side of being the third speaker is that most of my talking points have been taken away, but it's a great delight to listen to some of the seniors in this space. You have been excellent, and Saurabh, I got so much to learn from you. So I was actually hoping to put a spotlight in terms of how the reality has been right now in India, because I'm right now dialing in from Delhi. So I think whenever something as crazy as 30% happens, we go back to a basic human nature of fight or flight. And right now, it looks like the fight option is not there, because the central bank is trying to keep its powder dry to figure out and to put its head around a lot of complex issues. But as Vinod said, the flight option here looks like the brain drain, and taking a flight to Dubai or Singapore, because 30% is just so huge. And adding on to that, the 1% TDS. And when we talk about the 1% TDS, we don't really know how it's going to pan out for the intraday traders, because they're doing so many trades in a single span of hour, how it's going to work for them. And then interestingly, when we talk about the fact that now our honorable finance minister has made this very clear that she's going to tax digital asset. So that's a welcome move, because now finally we know that the cryptocurrencies, the private cryptocurrencies, virtual currencies are now classified as digital asset. We are not looking at them as currency, because we also know what RBI is planning to do. It's going to have its own digital rupee coming up very soon. And which means that in any case, we didn't have a lot of use cases coming from India in terms of how these currencies can be used in the virtual world for payments of goods and services. That was never the use case here in India. So it's clear that this is an asset, and this is how it's going to be taxed. But now the tricky part is when we talk about the gifting angle in it, because whoever is receiving cryptos or NFTs as a gift is also liable for the taxation. And as Saurabh clearly pointed out, talking about the example of airdrops. So airdrops is typically coming from a new, fresh project. And these tokens are given away to the community because you want to show your support to them. You want to get their support in the near future. And when you give these airdrops, they don't really have any value. So how would you tax something which doesn't have a value? And that goes back to what Amitendru, you were saying, that when we don't know what's the value, how would you tax it? And in the next case would be the NFTs, because let's say if I'm getting some NFTs, some pictures of Mr. Bachchan in a non-fungible form, how would I know the value of it unless I enter the market and liquidate my NFTs there? So again, the question of liquidity and value crops in. And I think this is the reason why the regulator is keeping his powder dry, because they don't know how they're going to enter into this arena. But on the ground reality, I think it's equally tricky for people. Let's say if I don't have taxable income and I've been filing a nil return, and now suddenly I'm supposed to be filing my taxes, paying an advance tax, there's a TDS element, for all the crypto earnings that I have in India. So I think from a retail investor point, it's a bit tricky, because 30%, 1/3 of your earnings are being swiped away. And at the same time, you don't know what it's going to look like in the regulation going forward. And comparing this to what India is planning to do in the CBDC space, let's look at what has been happening worldwide. because we're talking about 89 countries that have been experimenting with CBDC space. And when we say CBDC, we're looking at wholesale and retail. Singapore has been the first country, and I'm sure Saurabh has also been involved with the MAS in one form or the other in rolling out Project Ubin, where they were launching wholesale CBDC. And then we compare this to the retail example of the CBDC in a country like Cambodia. And like Vinod was saying, the perfect example of financial inclusion, and most of the work I do is focused on how to use fintech as a force of good for financial inclusion. And I feel that CBDC is a perfect sweet spot to solve that problem, because these people are now suddenly leapfrogging. They don't really have access to fixed mobile or any device. And now they're suddenly part of the digital ecosystem, because we know when we're talking about the future of currency, it's digital. And now these people are making the transition from offline to online. And Cambodia, through its project Bekong, has actually been the first country in the world to launch retail CBDC, because they are in a position to offer a platform which is interoperable. And at the same time, it helps with de-dollarization as well, because we know that Cambodia has been struggling with two currencies in a small country. And the latest report goes to show that the country has managed to get so many people under the CBDC net, because now these people are able to use the digital form of the fiat currency, and it's helping the migrant workers immensely. And the last part of this game, I think, let's not forget what's happening right now in Russia. The SWIFT channels are being cut for them. And then when we look at what really triggered the process of CBDC, we cannot forget what's happening in China. China has been at the forefront of CBDC. I was listening to Saurabh very attentively when he was talking about the McDonald's example. And in the last 2 years, China has been giving away the red packets. Most of us are in Singapore, and we know this practice of giving away red packets during Chinese New Year. And these red packets are having the virtual or a digital yuan, which means that these people can literally walk into Starbucks, McDonald's, and use the digital currency there. And why is China doing that? Purely because 90% of all the transactions, the payment transactions, are being ruled by WeChat or Alipay. And since I'm writing a book on super apps, it's fascinating to see that people in China spend at least 3 to 4 hours on one of these apps. And our Chinese government, the People's Bank of China, is worried because they want to break this monopoly of data collection. They want to collect the data. And as Amitendra, you were talking about the digital trail, and this is what they want. They want to know the source of money. They want to know where you're spending, what your habits are. And at the same time, we know the relationship between China and the US. So I think it's a perfect spot for them to work towards de-dollarization and also work towards financial inclusion, because we're talking about 1.7 billion unbanked people in the world. And I think we have seen a lot of private initiatives, but it's about time that we get to see some of these initiatives coming from the government side as well. And as you were saying, Amitendra, in the initial part of your talk, that COVID has been a precursor to all these developments, because suddenly we were forced to go digital. And this also means that once the CBDC is rolled out, the central banks would be saving money on the handling of the notes and the currency. We as people want to stay away from currency because we want to be making sure it's hygienic. We don't want to sanitize our hands. And then the ease of payment has actually been possible through CBDC. So I think that's that from me right now. And I'm waiting to hear what the other panelists have to say about the retail aspect of CBDC and financial inclusion. Thank you.
Thank you, Neha. That was brilliant, and I think you really were able to bring this conversation into, I think, a very well integrated and yet very global space. Because thank you for connecting it to all the relevant examples around us, bringing in the instance of China, the reflections of how transactions can be connected to the larger growth of digital currencies. And I think most importantly, what you allude to makes us very aware of one particular fact, that whether one likes it or not, digital currencies are here to stay. I mean, there's a lot of connection, quote unquote, to digital currencies that users have developed for them over the years. And there is also, in a strange way, I find that regulators are a bit reticent or embarrassed or shy to actually discuss the fact that digital currencies are indeed the way forward in a digital world. But I think from what you shared with us, these are reflections that are really very solid, very legitimate, and very genuine. And thank you so much. And we are going to come back to you with a lot more in the course of time that we have with us. And now let me invite Meghna Bal. Meghna, you are with the SIS Center in Delhi, a fellow over there. Meghna is a consultant with one of India's leading research advisory firms, the Quant Advisory. So I think, Meghna, you are also a trained lawyer by practice, and you have been looking at cryptocurrencies for a long time. And being this kind of the last speaker on the panel who has been exposed to the thinking and the understanding of the subject till now, I think you're perfectly poised, Meghna, to kind of bring us up to speed with your additional expertise and experience on this. Over to you, Meghna.
Thank you so much, Dr. Palit, and thank you to all the speakers. I'm really honored and delighted to be on this panel with you. So like Neha said, a lot of my speaking points have been taken as well. So I'm going to kind of go back to basics and taking a cue from Saurabh, who I agree with, keep the discussion on CBDC separate from, let's say, private cryptocurrencies. So going really back to fundamentals, in my mind, there are two types of crypto assets when I talk about private crypto assets. There are native crypto assets and non-native crypto assets. And the prime distinction between them is that a native crypto asset has some kind of decentralized system to which it is native. That means that it acts as a fuel for any kind of transaction that is carried out on that ecosystem. For example, if you want to build a smart contract on Ethereum, you pay a fraction of Ethereum, which is known as gas, and you launch your smart contract or you build your smart contract. Now, why I'm emphasizing the difference between, private and native and non-native crypto assets is that there is a lot of discussion in India about how blockchain can be segregated from crypto. I think that's a misnomer, because without crypto, you don't have a transaction recording mechanism for your decentralized ledger technology. And the benefit of native crypto assets really is that they exist primarily on open blockchain networks, which present an important innovation imperative for India. And we've seen that innovation imperative come to fruition without any support from either the formal private sector or the public sector. We have things like InstaGudge, which has been started by an 8th grader. He launched not one, but two crypto businesses. And then we have Polygon, which is really emerging as a prominent scaling solution for Ethereum. So we have all these important imperatives, and I think this is important, necessary context for my next topic, which is the tax, which has been discussed to a very detailed extent, but some of the things that have not been highlighted are primarily the challenges or the unintended consequences of this tax. Yes, it has been brought out. I mean, the rate of 30% is basically the same as the highest rate for short-term capital gains in India. So short-term capital gains above 10 lakhs are taxed at 30%. It also introduces a transaction tax of 1% for every transaction. This covers not only fiat to crypto transaction, but also a crypto to crypto transaction. And in such cases, especially the crypto to crypto transaction, the person who's initiated the transaction, which is another thing that I think will be difficult to gauge, has to ensure that the tax is paid. So some of the challenges that I see with at least this transaction tax is, one, it doesn't really accommodate high frequency traders or the people who are buying crypto and transacting in it to build. Also it places an unfair burden on the assessee to calculate the tax deductible, although they have said that they will bring out guidelines to, ameliorate this process. The second problem or the second issue that I see arising from this is that they've carved out an exemption to reduce the enforcement and implementation burden of the tax scheme. So there are two classes of persons that are exempt from the TDS requirement. Those who pay a total of 10,000 rupees for virtual digital assets in the financial year, and a special class of person known as specified persons. And these specified persons are essentially people whose turnover or business receipts from business do not exceed a crore or a crore for one financial year. So this is likely to be misused, as most loopholes in tax schemes are. People will just get people they know or people who work for them to place orders and keep it under that threshold of 10,000 or 50,000 rupees. So I guess they're going to have to adapt it at some point in time. But really, the biggest blow from this will be to the innovation imperative and to people who are high frequency traders on this. In terms of CBDC, India has been really, really bullish about coming forth with its CBDC. And like Mr. Rai correctly said, that there are risks of bank runs, there are cybersecurity risks, and there is a heightened risk for money laundering as well. There is also a concern about something we call an agency problem, which is when a government agency is involved in an industry where the private sector is involved as well. There is also the problem of what I see really as the primary problem of what the regulator does not see, because it does not regulate this area directly. And I'll give an example of recurring payments. I don't know how many of you are familiar with this, but the RBI kind of came out with a blanket prohibition of recurring payments, or not a prohibition, but basically you have to, every time a payment comes up, and I think Singapore has something similar to this, the customer has to approve it. Now that not only makes it a little inconvenient for you as a consumer if you have multiple subscriptions that you're dealing with, but it also really hurts you as a business, because it hampers your cash flow almost immediately. And there were, the fallout was pretty large from this. An unforeseen consequence of this is that a bunch of stakeholders known as merchants, who are essentially e-commerce players who the RBI doesn't regulate directly, were also impacted by this because they have a recurring payment system as well. So there are, in terms of a CBDC, what I think of as first order, second order, and third order challenges. The order of the challenge is determined by how far removed it is from the financial regulator's ambit. So an example of a first order challenge in terms of a retail CBDC would be, money laundering, theft, and of course, danger of network failure. Second order challenge would be that it would disrupt or disintermediate UPI or other payment intermediaries. And then a third order challenge is that it may affect, let's say, the quality of service parameters and regulations for telecommunications. And so one of the concerns or considerations around CBDCs is that it will require heavy coordination between not only the RBI and the Ministry of Finance, and let's say even the Ministry of IT, which is the Ministry of Information Technology. But because it is money at the end of the day, and it touches upon every element and aspect of the economy, there will have to be widespread coordination across the spectrum of governance and oversight. And so I'm going to conclude there, because I think I've kind of touched upon both things. But really, I think what needs to be done, both in terms of crypto as well as as well as CBD. Well, in terms of crypto, I think you need to consider the opportunity more and the imperative for innovation, and the fact that India in this frontier technology has a lot of talent and is quite far ahead of many countries. And in terms of CBDC, I think there needs to be a little more thought given to what the unintended, unforeseen consequences could be.
Super, Meghna, thank you so much. In fact, I really could not have expected for a more fruitful wrap up of the initial comments that we have had on this discussion. And thank you so much. One can really understand, the extent by which you have been following this subject and commenting on it and sort of, being engaged with it. And in fact, now this is how I thought we can go about the next round. And I wanted to reverse the order of speakers without asking for any of your permissions. So, Meghna, I want to start with you now on some of the questions that I have for the speakers. And in the first round, I wanted to go a little deeper into the question of taxation. There's a very simple question, Meghna, which I wanted to put to you. You've been following cryptocurrencies as an expert, and you're also a legal expert. Now, this announcement in the Indian budget, virtual digital asset, a tax of 30%, there has been this issue that, does it mean that the cryptocurrencies have been legalized? And I remember, notwithstanding the announcement that has come in the budget, there have been views coming out from the central bank in India that cryptocurrencies, private cryptocurrencies, should be banned. They should not be allowed to float. So how do you look at this as a legal practitioner when you advise your clients who would come for your counseling on this, that does this 30% declaration mean that private digital currencies in India are legal?
Right. It's a very interesting question, and it has, unfortunately, not a very short response. And
Go ahead.
being a lawyer, of course, I'm going to give a very convoluted response, because that I would not be true to my profession if, the answer was straightforward. So if you're taxed, all income is taxable. Even income that from illegal proceeds is taxable. So there are cases where, someone earned money from extortion, it was taxed. The only difference being is that there is no specific bracket that has been created for, proceeds from criminal activities. So there's no bracket that's been created for extortion. Like if you earn money from extortion, there's a 25% income tax that that is charged on that. The legality or illegality of crypto is quite not that complex. It is not illegal because it is not regulated, and it is also not strictly legal as well. And in fact, it was just agitated in court in a court proceeding a couple of days ago, where the Supreme Court asked the government to come back on whether Bitcoin is legal or illegal, following an investigation that's being carried out by the Enforcement Directorate against someone who is at the helm of a scam involving cryptocurrency. So technically, it's not illegal, not legal. It's operating in a gray area, but yeah, it's definitely not legal. I would venture towards saying that it is legal. Whether the tax scheme itself indicates that they're moving towards regularizing it and regulating it, I can't really say, and I don't really want to say. But it seems that there is difference of opinion amongst decision makers on this topic. And as Michael Patra pointed out, in fact, recently, that the RBI's strong views against cryptocurrency is probably what's delaying the formalization of these assets in this in India. At the same time, I would say that, the induction of a specific scheme towards regulating or towards taxing virtual digital assets does indicate to some extent a regularization, but I'm not going to make any predictions as to what that means for the long term, any long-term movements on regulation of this subject.
Thanks, Meghna. In fact, I think your answer is sort of not a direct answer to the question that I raised, but I don't expect it to be direct because there is so much of obfuscation around the subject at this moment that I really don't blame you, because you are in that community to which people will reach out for practical advice. And I can fully understand your predicament in this regard, because there's too much of, I think, confusion and nebulism surrounding this whole subject at this point in time. I'd now like to come back to Neha, but before I come to Neha, this is just to reach out to everybody who have connected with us today and to let you know that you are most welcome to pose your comments and questions on the chat forum. And if you wish to address a particular participant in that respect, please mention that on the forum as well, and we will do our best to accommodate our queries. Neha, you see, I think there's a phenomenon which we are beginning to understand when we look at the digital currencies, that across the world, the regulators are grappling with moving into a parallel system of regulations. I think what they understand is that from a sovereign's point of view, proposing a digital sovereign currency involves one particular set of logistics and regulations and so on and so forth. But when one looks at the other side, regulating private digital currencies or cryptocurrencies is a completely different ballgame. Now, you've been following this from a fintech perspective. Would you like to share with us some of your experiences in this regard, in the sense that you alluded to China, you alluded to a couple of other countries, you know of the Singapore experience. Where do you think, in what way are countries trying to navigate this, riding two boats together, if I can put it this way? Over to you.
Thank you, Amitendru. When you said riding, I thought riding the choppy waves. So I think when we talk about India, it has been a strange market. And I think Vinod did justice to that in his talk, because he was talking about what the stand was and how it kept changing. So when we watch the timeline, it seems like an interesting journey for us. But if I were to really simplify how India looks like to me, I think it's a great step, taxation, which is a welcome move. And now we're getting towards perhaps, let's say, guidelines, if not hardwired regulation, because I think when we talk about guidelines, easy to issue and kind of give the guidelines, and not so much of a heavy duty consultation process as well. And that means that, you're not stifling the innovation, you're not staying away from innovation, you're trying to let the industry thrive and figure out its own pace. So this is how it looks like in India. But compare this to, let's say, a Singapore, which is highly regulated. We are talking about the Securities and Futures Act, SFA, which regulates this business. And when we are looking at STOs, the security token offerings, that's how you have to go down that path, comply with everything. And when we talk about what's happening closer to home with Binance, it goes to show that Singapore has zero tolerance when there is not compliance done with respect to KYC, AML, and therefore it's all about who's going to check the boxes and comply with what's written in black and white. And this is the stand which we see with big fintech hubs around the world, because in the UK as well, the Financial Conduct Authority, which is the equivalent of MAS there, they have also regulated this in such a way that they have put it very clearly how this business is going to be licensed. So I think when we talk about all these progressive regulators, they're putting it clearly in terms of how it's going to work. But having said that, like Meghna was talking about Supreme Court hearing just a couple of days back in terms of a scam. And we have seen that in Singapore as well very recently, the FAT pig butchering event, right? Where you want to make sure that the pig becomes fat enough before you butcher it so that you can enjoy it so much. And that's what was happening in the crypto space for such a long time, because all these scammers from China, those who were active since 2016, they exhausted their local markets, and now they were capturing all the Chinese in Southeast Asia, Chinese-speaking population. And we know of the scam, and then the recent move where MAS has come up with guidelines that you cannot have crypto advertisements in public areas, in MRTs, and then you cannot be using social media as well. A similar thing happened in India, where Supreme Court has come up with guidelines, and the advertising authority has also said the same thing, that you cannot, if you're in a crypto business, you cannot be using words like currency, security, custodians. So I think it's good to see and appreciate that the regulators really want to watch out for the general public, because trading in Bitcoin, the so-called digital gold, seems like this is a quick way to make money. And this is not true, because right now we as experts, so-called experts, are also struggling to figure out where we put this aspect into and how it's going to look like, how to forecast this market. But let's not forget all these crypto currencies that we're talking about, 9,000-10,000 currencies that we have around the world. They are just in the nascent stage of any asset class. So they are highly volatile. And therefore, when we're talking about jurisdictions in Southeast Asia, we would see that Cambodia has been at the forefront. We have spoken about the CBDC experiment there. Singapore has been doing similar experiments in the wholesale CBDC space, and they are regulating it. And from time to time, we see all these guidelines also coming up, which gives us clarity and much comfort. But it doesn't mean that if I'm scammed, I really have any recourse right now, because it's a gray area. Therefore, while as an investor, we think whether it's banned, it's legal, it's not legal, we're just looking at the highest figure we want to put and not worry about, even if things go wrong tomorrow. But I think when we talk about smaller markets in Southeast Asia, like Vietnam, they're still trying to figure out what their stand is. But markets like the US, Japan, Korea, they have been regulating it, taxing it. And at the same time, we have Belarus, where all the merchants are regulated to accept crypto. They're coming up with the crypto city, a Bitcoin city. So I think it's interesting how when you move from one country to the other, the spectrum changes so much. But the bottom line is that if you really want to make money in this business, I would say that you got to be very careful, because you spend some money, you invest some money today, and when you wake up, things have changed drastically. Tesla said that they will be accepting Bitcoins, and then Elon Musk made a U-turn the minute he realized that it's not good for the environment, the mining feature of it. So I think, like Vinod said, it's all about keeping your eyes and ears open to understand what the regulator is saying or not saying sometimes, because they really want to make sure that the retail investor is safe.
Well, Neha, thank you so much. In fact, I'm really tempted to kind of go a little deeper into this question, the geography, Russia, Ukraine, Belarus. We are looking at them from a completely different geopolitical perspective now, but when the dust settles on that geopolitical turbulence, and perhaps 3-4 years later, when we look back at this development, who knows, we might actually think that they took the world of cryptos and digital currencies in a very different direction. And that was, in a sense, a turning point. Let's see if we can revisit that subject with you once more during the program. But let me turn to you again, sticking to the taxation element. You see, obviously, there is this objective insofar as the Indian budget is concerned, that there are expected to be a considerable amount of gains, speculative gains, coming out of virtual digital assets that are speculative by character, obviously the non-sovereign ones. And there is a tendency to capture those gains and tax those. But what I wanted to check from you is that, when looks at it from a tax imposer's perspective, given the volatility that we have seen in these assets as an asset class, it's not just a question of the gains. I mean, there's also a question of the loss to be taken into consideration on the other side. I mean, this is not really a real estate market that you are taxing. You're taxing something which is undergoing enormous fluctuation in asset value within minutes. And then on this, I also wanted to check with you that how do the twain exist? I mean, there is a system of taxation that has been proposed for the virtual digital assets. On the other hand, there is a sovereign digital rupee that is expected to prevail transactions as we go ahead. So do you sense there could be some challenges in a harmonious coexistence in this regard?
So maybe I'll take the second question first, maybe the first one after that, right? Yeah. So to me, I would be honestly surprised if there is a divergence in the peg of an Indian rupee to an e-rupee or a whatever it's called, right? Like the peg is fundamentally the same because it is just a new technology construct used to make that option available. So it's not just like the rupee is the same whether it's lying in your bank account or in your note in your wallet. To me, the rupee should be the same when a central bank version or central bank digital currency version of it is launched. And at its core, a currency issued by a country has the sovereign supporting it. It is a legal tender in that country, but it is fundamentally meant to serve three things, right? Store of value, means of exchange, and actually unit of account, right? That's the fundamental like three building blocks of it. And I can tell you crypto, as in Bitcoin, Ethereum, will never replace unit of account, at least in my personal opinion, just because of their volatility and nature and everything. So every country will have to pick a currency which is already in play. They're simply picking a technology platform to enable more efficiency and everything. Now, if I looked at those three, unit of account, the currency already covers. Means of like transfer and exchange, it will be acceptable everywhere in the country. Store of value, why do people invest in different asset classes? Because they fundamentally believe that certain currencies in that country they belong to are not storing the value. High inflation rate means that their value is being eroded. Then some people use that into other speculative assets. So I think fundamentally, I think the CBDC version of a rupee, whatever it's called, will coexist as an alternate means of payment, acceptance, and unit of measurement and everything else by itself. And I don't know why would you tax it, because it is just a form of exchanging money in the country. What you would tax is all of the things that you already tax today, which is activities and constructs and wealth and everything else. If anything, the CBDC will enable you to tax it much better, because the minute it exchanges from person A to person B, you could actually program it to inherently take out tax. When a smart contract happens, something else can happen. Again, that's for the future, but that's one part of it, right? I think the basic construct of taxation of cryptocurrencies on a personal level for me is still very hard to work around, right? Because I actually, like I said, I have friends in different parts of the world who are involved in cryptocurrencies or purchase or sale of NFTs or other things. And when I speak to them, some of their challenges are real, right? Like, so here is an individual who I know who actually is from the US. He made a reasonable amount of money last year. And actually, the market cap for crypto has gone from $3 trillion to $1.6 trillion. He doesn't even have money to pay for the taxes on gains that don't exist anymore, right? Because, so what should he do? Should he now pay for taxes at that point of time, but then try to figure out, which means he'll have to sell it, which he'll have to sell now at a time when the asset is low in value, right? Because a lot of these people are not selling the asset. Is it only on realized gains, unrealized gains, moving between one of the basic strategies for any form of wealth is when you think something has gone up too much, you almost switch to another asset class, right? Rotational trade within the sector. Now, as soon as they rotate, they're actually exposing themselves to high tax constructs in that thing. What do? Some of those nuances are even more messier, because in NFTs in the US, they basically said, you are taxed at the high rate, but if you can't sell it, then you still have to pay the higher tax and cannot recognize the loss. So now in December, a lot of these people are looking for people to buy their NFTs at almost free, which they were saying, it's actually worthless, but because nobody's buying it, I can't recognize the tax loss. So I think it's nuances like that that need to be understood and thought through, because if you're not close to crypto and you're setting policy decisions, you may not recognize the challenges out there.
That's very well spoken, Saurav. I think these are, subjects on which there's no way one can say that the jury is out there, because they are so evolving in character and probably changing on a daily basis. And the fascinating part of it is that they've got so much connected to the developments that are taking place around the regulatory space and so many other things, the developments in data laws, the developments around cybersecurity, the developments around digital trade, that it's practically quite impossible to look at even a short-term foreseeable future and see to what extent the regulations will be shaping out in that regard. We are probably very, very exploratory in that regard. And on that, I wanted to come to you, sir, Mr. Vinod Rai. I had a question on my mind, but I thought I'll connect it to one of the questions that we have on the chat forum. And there's probably nobody better than you to reflect on this. And this question is that cashless transaction is increasing in India, as we have seen from a rise in digital payments. But India, by its very nature, maybe because of its informality to a large extent, continues to remain a largely cash-based economy. And the Reserve Bank of India and the banks have a clear mandate to perform. I mean, they manage the monetary policy, they have developmental objectives as well, along with a regulatory objective. So when we look at the sovereign digital currency coming in this regard, what does it actually mean for the banks, and are their roles going to change in some respect as we look ahead? And a part of this question is that will the introduction of a digital rupee also lead to large costs, because there's bound to be a systemic and an infrastructure overhaul that will be required in that regard. And in that process, a lot of the existing banking infrastructure, the internal banking infrastructure and the role of the intermediation, the way we understand it, might actually become redundant. So there's nobody better than you to reflect on this. What would be your thoughts?
We need to understand where the RBI is coming from on this issue and what's the stand that the government has taken. Introduction of a digital currency will undoubtedly, and I think Neha pointed it out by saying that huge amount of infrastructure will have to be set in motion, and that expense will have to be undertaken. But the best point is, I think, again, Neha pointed out that Cambodia has introduced it, and the transition has been very smooth in the sense that the public has leapfrogged into a new era entirely by switching very conveniently to it. Now, when the RBI looked at the cryptocurrencies of Bitcoin in 2018, where was it coming from? No KYC, no due diligence, no AML kind of things. There was issues about combating terrorism, etc. So without imposing a ban on it, it advised the banks not to encourage transactions in these kind of things. The issue was there was nobody regulating Bitcoins. There was a total amount of digital encryption in the transactions, and it was totally decentralized in the sense that there was no parent for it. Now, when the internet operators or the mobile associations went to court, RBI took the stand that, look, there is no ban as such. But the issue that we need to take into consideration is, if we are going to move into a fintech kind of an environment, it is better that we go in for a currency which is digital but backed by the central bank, which means as good as fiat kind of currency, because the switchover to fintech over the last 2 years has been very easy, and it has been very robust. And a large number of so-called financially unincluded people have been able to make that switch over. So I would sincerely believe that infrastructure will have to be put in place. And I think RBI is concerned about that the infrastructure should be put in place before the currency is issued so that the risks of misuse are lessened. But at the same time, what I call collateral damage in terms of disintermediation as far as the banks are concerned, that will have to be taken care of, because it would be in the interest of the banking community, stakeholders in the banking community who are taken on board to push the CBDC forward so that they start trading in it also, and all the risks of this taken in advance, care of in advance, addressed, and then the CBDC is issued. I think that's how things will pan out. And that's where I feel the RBI is very concerned about the fact that the right kind of regulatory and infrastructure issues should be put in place before the currency is issued. I hope that answers your question.
Of course, sir, it does very well. And I think, the spirit of your response actually points to a particular understanding that when we look at a subject like digital currency from the point of view of maybe the ministries of finance or the treasury departments across the world, vis-a-vis those who have actually been in charge of regulating currencies all through the monetary authorities, we cannot really expect them to think on the same lines and the same path, because their responsibilities and turfs are very different. And in fact, this is something which the Indian example probably brings out very, very interestingly. And this is where, Meghna, I just wanted to come back to you that, when we go back to the Indian context, and I'm sure you're very familiar with this, that's why I thought I'll check this question out with you, that there's still this report which is pending with a committee in the parliament. There is still this view whether cryptocurrencies should be banned or called illegal. On the other hand, there's a digital currency. And perhaps the origin of all this conversation is taking back to the point where the Reserve Bank of India had an involvement in this court case, and there was an order to the Supreme Court where relief was sought to ban cryptocurrency, but the Supreme Court disagreed. And this is following the decision taken by the Reserve Bank of India to actually disallow cryptocurrencies, but then the Supreme Court overturned the ban. Now, what I wanted to check from you, Meghna, is that, look, I mean, I understand the Reserve Bank of India's hesitations in this regard, because no regulator would actually want to encounter the amount of disruption in managing currencies and currency operations in the country from an event which can produce momentous upheavals like, the one that we are expecting in India insofar as legalizing cryptocurrencies are concerned. But having said that, there is also this other view, and I think Mr. Rai alluded to in the beginning, that today there are 100 million crypto users in India, and statistics would show that there is a particular demography. The youth of India are very heavily engaged. You mentioned the examples of startups, 8th standards who are into this game. So do you think the views that the Reserve Bank of India brought in at that point in time in terms of their concerns over cryptocurrencies being legalized and the Supreme Court disagreeing on that, do you think that spectrum of views will continue to dominate the Indian approach to digital currencies and private digital currencies as we go ahead?
Yeah, I mean, you raise a lot of interesting questions. I guess the view of the central bank in India primarily is that they don't see any contribution to the real economy from this space, which I think is an incorrect conclusion, because, crypto presents potential for new types of commoditization of virtual goods, as we've seen. These include, and the concept of commoditization of virtual goods is not new, of course. Like if you're playing a video game, for instance, you can you can buy something, you can buy elements on those gaming platforms, but those are closed loop systems. Here, it would enable you to essentially purchase both real economy assets as well as digital assets. So intellectual property, you could create more concrete ownership provenance for intellectual property, for digital art, etc. Then, of course, it also creates potential for new lines of revenue for legacy service providers. So, for instance, if your Wi-Fi is idle, you don't use all your bandwidth through the course of the month, someone can come in, you can essentially monetize that unused bandwidth and give it to me, give it to a person like me who might not be able to afford a full month subscription. And then again, there's, like I said, there's the tokenization of real economy assets. But towards that end, and towards, the conversations around financial inclusion, specifically CBDC, India has a long way to go in terms of its technological capacity building, I would say, both for the state as well as the polity. And when you add a financial technological product, there's an added degree of complexity. And India is pretty far behind both in terms of digital literacy as well as financial literacy. I mean, people don't know how to use debit cards. So that is one thing to consider. The other thing to consider, especially in the context of a CBDC, is that to what degree are you going to have anonymity for this asset? Because that you have to have some degree of anonymity, otherwise no one's going to take it. No one wants you to know how many ice creams they're buying, or you as the central bank, or you as any state authority, what kind of purchases there. And so the degree of anonymity directly operates as an incentive or a disincentive towards adoption. And there are many degrees of friction that are, intellectual or mental in nature or psychological in nature that come in the way of, that dream of financial inclusion. And I think the biggest kind of testament to that is the fact that even though digital payments are big in India, but India is a very big country, cash is still king over here. And I think will be for a very long time. And that also has to do with the fact that the telecom revolution is not equally distributed across the country. So you don't have great quality of service across the country. There are wide tracts of land of areas across different parts of the country where you get no service at all. And a lot of these things kind of tie into each other. So I think that, just back to what I said, that, it has to be considered holistically. And I think that the more you go towards something, whether it be crypto, whether it be CBDC, with blinders on, the more likely you are, with a fixed view rather, especially with a technological construct, the more likely you are to have policy decisions or regulatory interventions which lead to really inconvenient, unintended consequences. And lastly, back to crypto, I think, look, the central bank has its view. It is concerned about the foreign exchange management implications, the fact that India has a managed capital account that plays heavily into it. But at the same time, if you don't regulate it, if you don't put provisions in place, this activity is going to carry on anyway, which is, I think, a primary concern for all those voices who are, pro-regulation as well, that the activity is going to carry on anyway. It presents a traceable, largely traceable form of value. So regulating it towards that extent would make sense, because then you have a means of managing it. The question is of whether the regulator, which would be the RBI, or maybe some combination of the RBI and SEBI, has the appetite to do it and also the capacity to do it. And I think that is where we're really at right now, is that the RBI, of course, is digging in its heels, but it has to. And I think that maybe again Michael Patra's comments indicate some softening of its stance, because he said that they're open to a fair discussion on this topic. And I think that's what's really needed, is consultation with consumers, with people who, both startups and exchanges, operators in the crypto space, and formal consultations that are transparent towards some kind of cogent regulatory solution rather than histrionics.
Great, Meghna, thank you. That was really very elaborate, very insightful. I'm mindful of the fact that we have exactly 5 minutes before I unfortunately have to bring to a close this extremely engaging discussion. So over these 5 minutes, I wanted to come back to Neha and sort of both of you with your response to one particular question that, again, this is India specific, and there is this allusion to the fact that blockchain technology will be used by the government for facilitating digital currency. But I think in the course of the conversation that we have had today, and Neha, I think you particularly alluded to the fact that there is a security issue involved here as far as its alignment with the data regulations and data privacy issues are concerned. So do you really think, to cut to the chase, that the use of blockchain technology can be taken forward in spite of the data concerns? Sort of, can we have you speaking on this first and then Neha, but briefly, please. Thank you.
So I think it's a valid concern. I think one of the things to understand in crypto is this whole understanding of pseudonymous identity versus real life identity. So it is possible that on a public blockchain ledger that a certain address is doing an activity. You may even know the pseudonymous identity of that person, which is almost a pseudonym, but you can actually, in many cases, not know who that person is. So that's an interesting aspect of that technology, which will develop further, where only certain legitimate kind of providers can decrypt on your authorization pseudonymous to your actual identity. Now, is that all in place right now? No, but various people are working on that as a problem statement to say, how do you bridge pseudonymous identities to real life identities and do it in such a way that you're not always making your data available to everybody. I think the aspect of CBDC, which allows tracking, that's a real challenge and a problem statement. If central banks across the world, not just India, become too prohibitive in their view of how they use that data, what it will lead to is people using more privacy coins, which will actually prevent governments or other institutions from tracking them. I mean, that's a real life scenario, right? So governments will have to figure out a fine balance between things that they want to track and they don't. And one of the examples of that is to say, maybe, I'm just picking an example in Singapore, right? Maybe it says anything below $500 is not tracked at an individual level, but anything above a certain threshold of value is tracked, and so forth. So I think that fine balance is important. Otherwise, people will not want to use those systems and find alternatives.
Thank you, Saurabh. That really reflects the volume of experience hands-on that you have had in dealing with this subject. I think that's exactly the spirit and the sense which must be passed on to the regulators as they grapple with this very complex set of issues. Neha, your final words on this particular subject.
I think, Neha, you're on mute.
Neha, you're probably on mute.
Thank you. I think I got too excited that I forgot I have to unmute myself. I was just going to say that data is the new oil, and therefore we see Facebook and the likes of Google, all these tech companies getting into the space of payments because they really want to know the consumer behavior. But the other side, like Saurabh said, it's also about money laundering aspect of it, right? Because we were talking about Russia, Ukraine, and the figures say 400 million crypto in money has been actually going towards the hackers for the ransoms into Russia. This is the figure for 2021. So this is a big chunk of money. 74% of the ransom money has actually been going to Russia. Now we don't know who these players are. They are these bad players. And I think Vinod would know all about the lifting the corporate wheel and then lifting off all these bad players and identifying who these people are. And I think this also goes to show why Singapore has done what it did with Binance, and it continues to be very stringent on this aspect of KYC, anti-money laundering. Not too long ago, we had demonetization in the country, and we also saw what happened to the currency notes, which were going to be banned in the next couple of hours. I have my cousins who were literally buying everything in the store because they wanted to get rid of their black money. And now all these bad actors and players have got into crypto space. And I think with blockchain, of course, it's possible to have all this security and the encryption, but getting to know who's playing this role and who's actually carrying out all these financial transactions, it has become very necessary because I have got my cousins who run businesses in China, and they have been sending money through cryptos to a Nepal route. And they keep asking me, can you suggest me a better route so that I can pay it in a more efficient fashion? And I keep telling them, this is not what I advise on. So clearly, I think there are people who want to use the system for their own benefit. But I think the government, the regulators, their intent is absolutely right. They're trying to protect the monetary policy by introducing CBDC or by making sure they work the CBDC platform on blockchain, because we have seen that many countries are not even thinking of blockchain. Like Vinod said, it could be DLT or otherwise. So it's very much possible to introduce CBDC without blockchain as well. It's just about how to identify who's carrying out which transaction.
Thank you so much, Neha. In fact, you have left us with a great amount of food for thought and probably directions, very, very compelling directions for the next set of discussions on this subject. We are at 5:31, and I first want to thank all of you panelists for being extremely disciplined, extremely focused on the time element. You have been a moderator's delight. Thank you so much. I also must thank you all for taking time off from your very busy schedules. I know we reached out to you at a very short notice, and thank you so much for obliging us. And finally, what I would like to say is that this particular subject of digital currencies is a very important area of study for us at the Institute of South Asian Studies. And on behalf of the Institute and on behalf of the Trade and Economics program that we run here, I think I, along with my distinguished colleague, Mr. Vinod Rai, would like to not just stay in touch with all of you for getting your inputs and suggestions on how we can expand and deepen and widen this program, but we would also be very, very willing to get your suggestions. Please write in to us. And this doesn't include just the very distinguished panelists that we had, but also all of you who were a part of the program today. And with that, thank you very much again. Let me return you to Divya. Divya, over to you.
Thank you, Dr. Palit. Thank you, everyone, for a very enriching and riveting session. Thanks to the speakers, thanks to Dr. Palit for moderating, and to the audience for tuning in. We hope to catch you all at our future events. Have a good evening. Bye.
Thank you. Bye-bye.
Bye-bye. Thank you.
Thanks, Amitindu.
Thank you.
Thank you all. Thanks, Neha. Thanks, Meghna. Thanks, Saurav.
Thank you.
Thanks, Mr. Rai.
Thank you.